Hello everyone. Good evening to this beautiful webinar. So the webinar is going to start about in 1 minute. Okay, do my audio is clear to everyone? So we have the chat section is enabled for everyone. So the people want to chat with me, or if you have any doubt, so just you can post it in the chat section. Okay, who are the beginners in the option trading? Okay, if any beginner, just you can put it in the chat section, right? So if you want to know from the exact basics of call and put and everything, so I'll start explaining one by one. Okay, fine. Actually, this section, so this webinar, okay. So what we are going to do, okay. So from the basic to the advanced level, I am going to cover one by one with the simple level, right? So what are the mean, how we can understand it? I'm just going to break down in a simple manner. So this will be as like an interactive session, right? If you have any doubts, so just you can put it in the chat section. So after clearing the chat, so we can move, okay, one by one. Okay, it's clear. Okay, so today the webinar topic is basic of option trading. So this will be as like advanced level. It will cover the basics. From the basics, we will move to as like a, so what is the trading system? How we can build a perfect the perfect actually trading systems, and what are the call and put, right? How we can manage the risk. Okay, so what are the tools necessary to create an edge in the trading system, right? So we will cover one by one. Okay. Okay, see here, actually, so currently I just put another slide. So do you see the type of options? Okay. So basically option having two types. First is the call option. Second is the put option. Okay. Because when you're purchasing a shares, okay. So what normally we will do, we just purchase the particular company share. Say for example, HDFC Bank. Okay. In the HDFC Bank, what we will do, we just directly go to the exchange and just place a buy order, and just we will get our shares delivered to our demat account. So if you want to exit the position, what we will do, we just sell uh, the particular stocks. Okay. Say for example, we brought 100 shares of HDFC Bank. So today we brought, so tomorrow, if you want to book a profit, we just square off the exact amount, or if you want to go for profit booking, you can exit a 0.5% and you can keep the remaining. Okay. So this is basically a buy and sell in a stocks. Okay. But normally what we will do in the options, right? Suppose if you're finding the stocks is in a bullish pattern. Okay. Suppose if you're feeling the stocks will go up tomorrow. Okay. Instead of buying the share, okay, you can buy the call option. Okay. Say for example, if you're feeling, so there is a heavy news, okay, heavy news tomorrow in a, as like say for example, the Russian elections is there, right? Suppose if there is a election, there is some upside and both side the fluctuation will be there. So if suppose if there is a downside fluctuation, suppose if you are holding 5 lakh worth of shares, okay. So just you can listen carefully, because it may look a very basic thing. Okay, it may look, Mr. Subramanian, actually it may look basic, but if you know exactly the basic stuff, so then we can go into the higher sessions. Okay. So just you can understand the basic of the option, because this is a very exact point everyone has to know, right? Because option is not created for as like a speculation, because the people what they do, they buy it today. Okay. and sell it by evening, or buy it today or sell it tomorrow. Okay. So that is not the case for option has built. So this is a risk management tool. Option is meant for a risk management. Why? Because suppose, say for example, if you have a portfolio of 1 crore rupees, you have a 1 crores worth of shares. Okay. Directly, if there is a news tomorrow, you can't sell all the shares today and purchase tomorrow. Okay. That won't make sense. Okay. What the HNIs will do, instead of just selling all the shares, they just buy a put option in the Nifty. Say for example, if they have the Nifty 50 shares, they will buy the put option in Nifty. So by the way, they will hedge their portfolio. Okay, it's clear? So option is meant for a hedging tool for HNI traders, and for small traders, if you have a 5 lakh, 10 lakh worth of portfolio, so we can also hedge with the put option. So this is the exact basic, this is the exact the purpose they have created the options. Okay. So I'll just repeat one more time. So options are meant for as like a hedging tools. Okay. To avoid the risk. Okay. Suppose if you are the HNI traders, if you have a portfolio of, say, for example, 1 crore or about some 10 crore worth of portfolio. So portfolio means shares. Okay. If you have SDFC Bank shares, ICICI Bank shares, say for if you have the Kotak Bank shares. Okay. Say for example, if you're holding 5 crore worth of bank shares portfolio. Okay. So tomorrow you are expecting there is a heavy news in the market. So there is a particular tool exchange has created, that is the options. With the option, you can avoid the risk. How we can avoid the risk? You can buy the put option. Because straight away, every day there will be some news will be there, or in the weekly there will be some what you call the data will be in the American market. They have some data, housing data, unemployment data will be there. At the time, market will have the wider movement, right? So 200-point market will fall today. Tomorrow, 500-point will just go upside, right? Every time we can't buy and sell our portfolio, right? That is a very hectic for the HNA traders. So for that, what they will do, instead of just selling all the portfolio today and buying it tomorrow, they will just buy the put option. Okay, this is to hedge the portfolio, right? Because suppose if you're selling all the 5 crores of the shares today, if you're buying it tomorrow, what will happen to the market? Market will just oscillate ups and down very heavily, right? Okay. To avoid that one, exchange has created the particular tool, that is the options. Okay, so that is a call and put options. So mostly HNI will buy the put options. That's why the option premium put option will be always high. Okay, put option will be always high at the beginning of the month. Later, if you are finding the call option premiums are getting higher than the put option, you should know the market is changing to a trend, so that have a higher momentum in the upside. Okay, we will cover all the premiums and the strike prices in the next. Okay, so basically understand it, there is a call option and the put option. So if you are feeling there is a momentum swing in the upside, okay, if you're feeling the market will go high and high, so just you have to buy the call option. Okay, suppose if you are feeling the market will fall, just buy the put option. Okay, so I'm saying option buy for call option buy and put option buy in the perspective for the speculators, in the perspective of traders, not for investors. Okay, investors, so they have only one option to hedge with the put option. Okay, so if they have in the portfolio, they buy only the put option. That's for hedging. That's for investors. So I'm coming to the point for the investors, for the traders. Okay, traders. As a trader, I hope everyone is the trader here. Okay, if you have any investor, just you can put it in the chat section. So let me know, right? So you came only for investor, not for trading. Okay, how many are traders here? How many are traders? How many are day traders here? Okay, fine. That's very good, right? So, so everyone is a day trader here. Okay, okay, that's fine. Very good. Actually, the trading is a very wonderful job, right? Very beautiful job. As that's so beautiful. When you go for a trading, right? So that's so awesome. Oh, that's fine. Okay, swing, positional trader, all type of trade, that's fine. Okay, let me come to the another section. So what are the component of options, right? So if you're a day trader, you know this. The first is the strike price. So all the options will have a strike price. Okay. So I have given this example. Say for example, Bank Nifty currently trading around 46,900 level. Okay. So exchange has fixed, not we fixed, exchange has fixed every 100 rupees, there should be some price. So that we name it as a strike price. Okay. On the particular strike price, we have the premium. We can see there's a 46,900, right? So nearby, we have the 292, right? Everybody know this one. So 292, that is a premium. Okay. So suppose for example, if the month end, okay, so month end every Thursday is the expiry. Okay. What will happen at the starting of the month? Premiums will be very high. Okay. Who is fixing the premium? Okay. Who is fixing the premium? We only fixing the premium, right? We both buyers and sellers are fixing the premium. Nowadays, algos are fixing the premium. That is another case. But we have both the buyers and the sellers are setting this premium. Okay. We should know this. Okay. This point everyone has to understand, right? Because this will be very useful when you are just going for a straddle trading. Who is fixing this price? We buyers and sellers are fixing this price. Okay. Suppose for example, if there is a trader, so tomorrow he is expecting there is a bigger movement in the market. Okay. What he will do, he just mark up this price instead of 292. He just put 350 rupees. Whatever the price he want to put, he just put it at the exact higher premium to take all the quantities. He knows tomorrow there will be some Bank Nifty, there is a higher 500 points moment will be there. So his premium from 350, it will go to 650. Okay, in that case, who is fixing now? The buyer is fixing the premium. Okay, once the one particular strike price, if the price is getting high, then all the in the money options will start moving higher and high because they call it as an order block. Okay, order block is defined by the volumes and the particular price. Okay, if there is a higher order block, the price will start move higher and higher. If there's a lower order block, then the price will start moving lower and lower. Okay, understand this given. Okay, so what are the component of options? First is the strike price. So Bank Nifty, so what is the strike difference? Every 100 rupees, there will be some strike price will be there. Okay, and they have the expiry date also. So Nifty and Bank Nifty, they have a weekly options and the monthly. Okay, and the third one is the premium. So every strike price will have a premium. Okay, so this is like a goal. You have to understand. So strike price is like a predefined goal. Okay, as like a predefined target. So what is the target of Nifty or what is the target of Bank Nifty, right? So we use it in a as for the as a day trader perspective, we use it as a target. For a strike price, just you can understand as like a target. So every month, so Bank Nifty will move 4% high or 4% low. Okay, so 4% high, 4% low. So our VIX is trading around 11.4 around vertical 12 per annum VIX. Okay, suppose if you're putting around vertical 10%, so there should be a movement of 4,500 point high and low every year. Okay, okay, that's correct. So here to avoid the because option is a hedging tool, so they want to buy a put. Okay, so to avoid the excess premium, so they created all the strike prices so that the better is HNI, they can buy at a very smaller premiums, right? Smaller prices, and they can hit the portfolio because some actually big traders, they buy at 40,000 levels. And after the market move around 42,000, another person buy at 42,000 levels. Likewise, there are so many person and so many HNI traders, they buy different levels. So that's why this strike price, so they just compounded for the easy hedging purpose. Okay. And the second is the expiry date. So weekly there is expiry and monthly there's expiry. And we have the premiums I have told you. So premium, what is the premium? So nearby prices, okay, nearby, they call it as a at the money price, at the money option will have the always higher premium. Out of the money will have the lower premium, because out of the money is the out of the range, right? So most of the option will go to zero, right? Everyone knows out of the monies will go to zero. So the premiums will be far away. Option prices will be always lesser. In the money will have always higher premiums. At the money, most of the focus will be at the money. Okay. Okay, fine. Up to this, everything clear? So we uh, so we just covered what are the options. So option is meant for the hedging purpose, and what are the basic of option, and second is the option component. We have covered it. Up to this is clear. After this session, everyone should be expert in options. Okay. After this session, when you're just leaving this session, you should be expert in option. You should know where to take a position, where should not take the position, option selling and buying. You should be clear in your lifetime, not for this. After this session, you have to be clear. There should be no other go. You have to clear from this webinar, and just from tomorrow, you should be 100%, 100% as a knowledgeable in trading. Okay. Not a half baked. Okay. We should be 100% in your trading session. Okay. I want that only. Okay. Next we go to the option buying advantage. Okay. So if you're an option buyer, okay. If you're an option buyer, so let you understand it. Suppose if you're an option buyer, because most of the traders are most of them are the day traders, they show option buying is a very limited risk. Okay. Because we put a premium. So we risk only the particular premium. If tomorrow, if anything happen, we lose only that particular premium price only, right? Suppose, for example, we brought it 300. So 300 into the 15 rupees of the particular quantity. So we lose only that particular amount. Okay. But our return is very high. Option buyers, okay, even though option buyers only 5 to 10% are they're making profit, but they're making the profit at very, very higher amount. Okay. And the second one is the better risk management, because option buying, from the point of this HNIs, when you're buying the option, buying the put option, if they having the worth of 5 crore worth of portfolio, they are risking only about 5,000 or about 10,000 of their the premium, right? So they can spend it, because if there is a backspan event or if the market is falling aggressively, they spend only 5,000, 10,000 in a particular put option buy. Say, for example, they brought 50 paisa, the put option. When the market suddenly falling 10,000, even the 50 paisa will go to 500 or 1,000 rupees. They can hedge it very safely. Okay. So that's why there is a very, very better and efficient risk management tool. Okay. And if you're an option buyer, you should be 100% know which side the market is moving. If you don't know which side market is moving, what will happen? Our money, whatever the money we put it for option buying, it will start eroding very fast. Because of theta decay, what will happen? Option premium will fall heavily. Okay, so that's why you should know 100% know the trend, whichever the market is moving. Suppose, for example, if you don't know, right, 100% accuracy, even if you have only 70% to 80% accuracy, what you can do a pyramid option strategy. Okay, so what is pyramiding? How the pyramid will look like? Starting from 1, second step will be 2, second step will be 4, second will be 8, okay, second will be, after that, 16. Likewise, if you are an option buyer, this strategy is a risky one, but with this only, you have an edge in the market. Okay. The first one I have told you, if you're option buyer, you should be 100% accurate. If you're wrong in even a 1%, premium will be just like that eaten by the market. Okay. Because if you are going, say, for example, if you have the capital of 2 lakh rupees. Okay. So you are ascertaining the market will go high from this level. Immediately market open by 9:15. So you just get into the trade, you just buy the call option. Okay. But suddenly after 5 minutes, what happened? Market is falling. Okay. Your premium, suppose you brought it 300 rupees, it will just go to 150 rupees within 5 to 10 minutes. Because we don't have any accuracy in the trend. Okay, so option buyer, you should have 100% accuracy. Suppose if you don't have the 100% accuracy, what you can do, right? What you can do, how we can escape from the option sellers, what you call the hand, right? You can do your pyramid option strategy, but you should keep the maximum risk. How much you can risk it in the option buying? You should be certain, right? How much you can make it per day, how much you can risk it. You should ascertain every day. If you're just blindly going to the trade in option buying, that's a very, very danger game. Okay, you are taking a big risk in the option buying. Okay, for that I given one beautiful method. There's a pyramid options. How we can do the pyramid option? So everyone can note down this one. Okay, first you have to go for a one lot of buy. Say for example, if you're finding a from now within about half an hour, the Bank Nifty will go high, will move in a higher side. From actually 46,500, it will go to 47,000. Suppose if you're feeling like that, say what you can do, you put one lot of buy. Okay, suppose if the one lot is giving about 10 rupees or 20 rupees, so you already in a better profit, just exit trade. But if the particular Bank Nifty is not moving high, it started coming down, what you can do, you can do a pyramiding of two lots. Okay, but that two lot should be at the half of the first buy options. Say for example, you brought at 400 rupees premium. When the 400 that is coming down to 200, just average another two lots. From 200, if it is again coming to 100, just put 4 lot. If from 100, if it's coming to 50, just put another 8 lot. One point of time, market has to come to high. The market cannot straight away go to 400 to 0. That won't happen within a day, right? Do the market will go to 400 to 0 in a day? Everybody can answer it. So do the market will go from 400 to 0? No, right? So in a particular moment, there will be some momentum will be there. So there will be some, first you have to keep it in the mind. Okay, everything is risky in this world. Even we are living, that is also risky. If you are breathing or without breathing, that also risky. Everything is risk in the market. There will be risk in the market. Option buy also risk in the market. So that's why I'm explaining option buying is risk, but that is a very limited risk. But the chance is very high, right? Higher potential. This has a huge number of potential. How we can manage? Because option, moment you get into the option buying, okay, Mr. Subramanian, I understand your point, right? So risk beyond normal level, right? We understand the point. So suppose if the market is coming down, market cannot straight away go to 0. Okay, market will have the ups and down, actually wider oscillations. Because option trading or the market is giving for the option buyer also there is giving opportunity. Option seller also there is giving opportunity. So just keep this in mind. Market always give opportunity for option buyers and option sellers. But 90% of the 90% who is getting profitable? Option sellers. Why? They have enough time for the theta decay. From the market start to the end, market will just all the premium will start eroding from the market starting to ending slowly, right? But option buyer also having edge. Option buyers, if you're accurate and have the pyramiding model, okay, or if you have the correct setups, okay, we also have the exit. I do option buying also, I do option selling also. So that is depends on the premium. If the premium is very high, what we can do? Sell the options. The premium is very low, just buy the options. It's so simple. And if you know the correct, what you call order, I told you, 400 is the, suppose for example, 400, we have buy the call option. We know market is moving up. When the 400 it start coming down 200, just put 2 lot. Our average will be 300, right? So again, from the 200, if it go to 100, put a 4 lot. So now our price will be, breakout price will be 230 around 240. So anyway, market has to give at least 100 rupees, 200 rupees, opposite side oscillation. At the time, we can exit the trade. Understand? Up to this, I hope this is an option. The pivoting model is clear for everyone now, right? If you understand this only, I can move to the another session. Okay, the capital required, start from 1 lot. Don't straight away go to 1,000 lot. Okay, start from 1 lot. For 1 lot margin. Okay, say for example on expiry, I am giving an idea on the expiry day. Okay, the morning expiry day, Bank Nifty option, what will be the price? Don't keep it the positional trading as per the assumption. So we can understand today is the expiry day for the Bank Nifty options. Okay, by 9:30, what will be the call option premium will be there? We can use it for intraday and for position also, because mostly option buying has to go only with the intraday. As for the buying, right? So if you know the positional trend only, you can carry the positionals, because position trade is your 100% risk. So tomorrow, if there is a small bit of against the moment of our trend, the premium will go to half of the premium what you have bred. So mostly option buying for positional is not recommended. Say for example, so today is expiry. So morning, what is the premium we can expect? Okay, around 200. So Mohan has answered correctly. So around 200, we can expect 200, 250 will be the call side premium. Another side will be 200 rupees will be the put side premium. When you compare both the straddle price, what will be the range? 400 rupees. So 400 will be the total straddle premium. Understand everyone? So call side will be say 200. Suppose if today is the Bank Nifty expiry, okay? So we are going for a day trading today, okay? So we are thinking we will make 1 lakh profit today. So we got into the trade. So by as in 9:15, market has opened around 46,700. So 4700 call option is trading at 200, and 4700 put option trading around 200. So what is our combined premium? So combined premium is 400 rupees. Okay, so combined is 400 rupees. So if you're taking another about so 10:30, so 11:30, so 12:30, so 1:30, so 2:33. So we have another 6 hours left. So in the 6 hours left, this 400 has to go to 0, right? So every 1 hour, so they have to reduce around 70 to 80 rupees premium. Understand, right? So if they want to reduce the call and put option premiums, so they will create a movement, right? So what is the movement range? 400. So we have to combine. I'm explaining everything for the day traders. So if you have any doubt, just you can put it in the chat section. So I can just will explain one more time, and you can come to this example. Okay. So our combined premium will be 400. So if the combined premium is 400 means what is the market is giving to us? Market has everything. Okay. Market will just speak to us. So we should be in the mind, we should be in a very calm mind to understand what the market is saying to us. Okay. Understand this one? So if the call premium is 200, if the put premium is 200, it means that market is expecting 400 rupees range either in the top side or in the bottom side. Is clear? This should be clear for everyone. Okay. This is a very, very important. If you don't know this one, we can't buy, we can't sell it in the market. We will be in an exact trap. Okay. This is the first point. You should be very clear. If the If the call premium is 200, if the put premium is 200, just add the both. We get the premium called straddle premium. Yes, that is at the money. I am talking about everything is at the money. At the money means what? If the price is 46,700, it means that if the Bank Nifty is trading 46,700 or say 47,000. So 47, we have one call option. Same 47, we have one put option. Just add the both. Just add the both. So we get one premium that is called the straddle premium. So this straddle premium speaking to us. So from this particular movement, so today our maximum movement will be 400 rupees either in the upside or in the downside. Is clear? Okay. According to the straddle premium only, sellers will take positions. Understand? According to the straddle premium only, sellers, what they will do, they will sell it 400 points away in the call option and 400 points away in the put options. Okay. Okay. Mr. Rajas asked how we can use it with the IV, the implied volatility for trading. So there is, because option premium already included the volatilities, right? So there is no need to confuse and just track all the IV separately. There is no need. Actually, that is already premium include all the fundamentals. Okay. Delta, beta, theta, everything covered in the premium. There is no need to confuse from your point. Just focus only on the premium. Okay. So next time coming to the option selling. See here, option selling is a, okay, I just put a limited risk. That's not a limited risk. So if they're selling only the naked options, that is an unlimited risk. If they're hedging with the hedging as like iron condors or a butterfly, so that is a limited risk. Okay. And they have to deploy a huge amount of capital. Say, for example, for 1,000 rupees to make a profit, with the 10,000 rupees in the option buying, we can make the 1,000 rupees, right? So if you have a capital of say for example, 1,000 rupees, in expiry day, with the 1,000 rupees, we can make it 1,000 also, 2,000 also, right? But to make the same 1,000, 2,000, option sellers, they have to deploy 1 lakh to 2 lakh rupees capital. Okay. Because they are the option sellers, because they are making the consistent return, right? So that's why the capital will be always high. Okay. Return is less. Even though return is less, they are making the consistent return. So they're generating the income every day. Say, for example, today they're making 4,000 rupees. On the capital of 5 lakh rupees, they are making 4,000 today. So tomorrow also they'll make 4,000. So when it is adding the cumulative time, the cumulative, in a month, they'll make around 80,000 to 1 lakh rupees with the capital of 5 lakh, right? Understanding? No? Because they are making slow and steady. Option sellers are making slow and steady and making progress. Okay. But option buy is, what is the hedge in the option buying? Say, for example, if you have the 1 lakh rupees capital, if you know 100% market is moving high within about half an hour time, market will go aggressively 500 point. If you buy 50 rupees, this 50 rupees will go to 500 rupees, right? With the 1 lakh rupees capital, same option buyer, in a single day, they'll make 5 lakh rupees. Right? So that is the hedge between the option selling and buying. Because option seller, they will deploy higher capital, making lesser return, but that return is a consistent return, and they making generating a wealth every month, slow and steady. But option buyer is a exact opposite. They are deploying a very lesser capital and they're making a greater risk, but that the capital is a risk. We should know, if you're wrong in an option buying, our capital will go to zero, right? But in the option selling, if you're wrong at a single time, we have some time to escape. Option sellers having a time to escape, not for option buyers. You have to keep it this mind. Option sellers having time to escape, not for option buyers. If you're option buyer, if you're wrong, straight away it will go to zero. Okay, straight away will go to 0 on the expiry days because the premium will go very fast. Even we don't have any time to recover it. In the option buying, you should be 100% knowledgeable which side the market is moving. Okay, it's clear in this point. You should be clear in this point in the option buying, option selling. Okay. Here is who are the option sellers here? Okay, in the webinar, who are the option sellers? Who are the option buyers? Can I know the how many are here option buying and selling? So just you can put it in buy and sell, so I can know the who are the option buyers and sellers. Okay, if you're option seller, just you can put it as a seller, so I can know. So I can give one beautiful strategy for selling. Else I can directly skip to the option buying strategies. Fine. Actually, Mr. Arun Kumar is the option seller. I think most of the people are option buying. Fine. Actually, I'll give one strategy for the option selling. Okay. So that is called the triple straddle. Okay. Okay, that's called triple straddle. So I don't know whether this strategy available outside or not, because this is a very beautiful strategy. Okay. So triple straddle, what we will do, the mostly option sellers know ATM, ITM, OTM, right? ATM is the at the money straddle. OTM is out of the money. Okay. Then ITM is the in the money. Understanding, right? So triple straddle. Okay. Just I'm giving the some idea about the triple straddle, right? I have another webinar already conducted in the what you call previously. That's about triple straddle. When you search it in the YouTube also, you will get the triple straddle. Okay. Actually, say for example, 47,000 market is trading. Okay. 920. Okay. 920. You have to know market is quiet or market is volatile. Within one single candle, within the 5 minutes, we know if the market is very volatile, first 5 minutes itself, Bank Nifty will move 200, 300 point. But if the market within the 5 minutes is not moving 300 point, it is moving only 100 or around 150 or around 200. What you can do, you can take a triple straddle, because after that one, market will be very quiet, right? The 50, 100 point movement, after the about some half an hour, market will be very quiet. What you can do, 47,000 call and put sell. Okay. 47,500. Okay. The call and put sell. 46,500 call and put sell. Understand this one? So what we are building a triple straddle selling. Okay, we are selling both the call and put at 500 difference. We should not directly go and sell 100 difference. Then we will be a trap of 300 rupees, right? What you have to do? This triple straddle is a very, very beautiful income generating method. We can use it for positionals. We can use it for intraday. We can use it for BTST. This is a very beautiful straddle. I am personally using this method. I use it for many number of years. I just would have thought to many number of peoples. This is a very, very beautiful strategy. Everyone want to generate the income, right? Just you can use this method. Don't simply go and sell the ATM. If you're selling ATM, what will happen? Say, for example, 47,000 market is trading. Okay. If you're selling 47,000 rupees, what will happen? Because market cannot stay at straight line in a 47,000. Within 1 hour, market will move to 47,200. Or market will come down to 46,800. Correct? Right. So at that time, what will happen? If you're selling 47,000, both call and put, the call will go to in the money. But put cannot reduce at the faster phase when you're comparing with the call option. right? But if you're doing a triple straddle, what is the advantage? You are selling 47,000 rupees, 47,500, 46,500, every 500 rupees gap. Okay. Even though if the market is moving 100 rupees, 200 rupees ups and down, this won't get affected. Understanding? Because we are having a difference of 500 rupees. If the market want to cover that, if the market want to hit us, they have to travel 500 rupees. 500 points they have to travel. 500 points, not to be 500 point. Bank Nifty has to travel within about half an hour. If it not moving half an hour, what will happen? Premium will start eroding very fast. Understanding this point? This for option sellers. I'm giving this example for option sellers. Okay, Mr. Subramani asked for a graph. Okay, I'll just take it in the option. Most of people know the Optra, right? Okay, the current price of the bond is 46,900. So what I can do? So we have the expiry on 27th March. Okay, I'll do one thing. I will sell it one lot of 46,900 and another one lot of 46. Okay, 900, 47,900 trading around 70. But we at least we need 100 rupees premium. Then only that is it has a huge potential because our range will get increase, right? So 46,500. Okay, everyone is seeing my Aptra? No? Okay, just a minute. Okay, capital required. Okay, I will say the capital required and everything. Okay, so just you can listen this point. Okay, see here. So current the market is trading around 46,900. Okay, able to see? So what I'm doing in the call option, I'm selling ATM. So this is ATM, right? 49,900. I'm selling one lot. 49,900. I'm selling one lot. Okay. 500 points away. That 40 is 500, right? 40 is 400, correct? 4,400. I have to sell one lot. So 46, 400. I have to sell one lot. And here 400 points away, 47, 300. 47, 300. I have to sell one lot. 47, 300. I have to sell one lot. So initially I have these questions. I can close these trades. After this webinar, everyone has to be an expert in the option buying and selling. That has to keep it in the mind. Okay, see here. Say for example, this is a ATM. ATM means that the state to state. Current price is 46,900. So 46,900 call and put is called ATM. Okay, ATM straddle. What I have done, see here, 46,900 I have sold. Another 46,900 put option I have sold. Okay, bottom that 46,400, 500 points down. 46,400 call option. 47,300 for the 500 points away, right? 500 means that is coming. Sorry, that is the 47,400, correct? 47,400. Okay. Okay. See here. So what is our maximum profit? 14,000 rupees. Okay. What is our the break-even point? So just you can listen, 47,550. Understanding this one? So if the market is currently trading around 46,900, market has to travel 500 points to hit our stop loss, or you just exit our trade, right? If the only 47,500 is crossing, then only we will have a loss. Else we will be just enjoying the profit. Understanding this one? In the downside, what is our break even for the downside? There's a 46,250. Okay. From 46,900, market has to travel how many points? From 46,900, the top set we have a cover of 600. Bottom also we have a cover of 600, right? So within a day, there is a chance of Bank Nifty is creating the 600 rupees movement within half an hour, within 1 hour? No, right? Within 1 hour or half an hour, market cannot move 600 points on every day. In a very, very rare case, it may go. Suddenly, there might be wider spikes. There might be news. At the time, it will move having a wider range. That's a very, very rare. Right? I said there is very lesser chance. So here the profit potential or the market is reaching 600 within 1 hour is very, very less. What will happen? Premium will start eroding very faster. If you're going for a naked selling, we require 3 lakh rupees. What we can do? So just you can straight away come to this line. So 47,400 we have sold, 1,000 rupees away. 48,300 we can buy. How many we have to buy? 3 lots. Okay. Same here. 8 rupees or 10 rupees. I can go for a cover. So buy 3 to hedge the trades and reduce the capital. So now what is the capital? We require only 1,79,000 only. Half of the premium, half of the capital required, right? So, but we are making a healthy profit of 13,000 in a day. If there is no movement in the market, we are straight away we are making at least about 10,000 rupees in a day. That is for a capital of 1,79,000. This has to keep it in mind. This is for a seller perspective. So they are enjoying the huge amount of profit if there is no movement. So this is around about some 8% return in a day. Understanding this? Yes, brokerage will be very less because actually brokerage, in a single side we are taking the trade. So it will be if there is a 10 lakh, so they'll put some 10 lakh 150 rupees or 300 rupees. They will take. That depends on the broker. So Allies Blue, they're charging only 15 rupees, I think so. So 15 rupees. The plus they have the taxes will be there. Depends on the premium, the tax will be there. So 15 rupees. So for selling 15 rupees will be there. So that is very, very less, right? So if you are trading, we have to pay that brokerages and everything to the broker to make profits, right? So our capital is around 1,79,000, but we are making, how much we are making? 13,000 rupees we are making. Okay, Mr. Subhas, there will be some recording session will be there. After the session over, it will be uploaded in the YouTube in the channel Babaji Robo Trader. Okay, or else you can ask the Allies Blue, so they will give the recorded sessions. Yes, I'm sure, Mr. Jayant, I'm showing the P&L and everything in the Optra. So this is for the Bank Nifty. Okay. So this you can do for positionals unfunded. Currently, we don't have the setup for option selling. We have only for option buying. Okay, our YouTube channel is babajirobotrader.com. Babaji Robo Trader. Just you can type Babaji Robo. So you will get the channel name in the Google. So that is Babaji Robo Trader. Okay. So this strategy is called a triple straddle. This we are using for option selling, not for option buying. Option selling, how we can avoid the risk. So mostly, most of the 90% traders, what they will do, they will sell it at the money and they will wait for the break-even point. Mostly they will break you. So they will exit within half an hour to 1 hour because immediately if the market moves 100 point, one premium will shoot up very fast, another won't get the premium won't get decreased. They'll be in a big trap, right? So that's why we created the triple straddle. So what the triple straddle? So 46,900, if it is a market price, so just sell at the money straddle, right? And 500 points away, 47,400, both call and put. We are not selling only OTM. We are selling both the ATM options, both in the call and put. Okay, we just keeping only the strike difference. 40 is 900, 500 point below, 40 is 400, 500 points above, 47, 400, right? So we have the 6 legs, 1, 2, 3, 4, 5, 6, plus we have 2 hedging legs. That's the, we have one, say for example, here we brought 3, we sold 3 different strike prices in a call option. So we had to hedge with the 3 or more, okay? So then only we get a lesser brokerage. Say for example, instead of 3, if I just increasing this lot, what will happen? Our premium will just keep on reducing it. Say for example, instead of 48,300, if I hedge with 48,500, see here, our premium will start decreasing slowly. Instead of 45,500, if I hedge with 45,500, what will happen? See here, we saved another 20,000 rupees premium. Understanding? Okay. Also, we saved the premium, but our our profit ratio will just decrease only 200, 300 rupees in that one. But till we are making the maximum profit of 13,000 rupees. Up to this is clear? Up to this is clear? This strategy in India, the whoever this attend this webinar has to be get clear. It should be fixed in the mind. Even if anyone is asking in the future, you have to explain this one. If anyone in your community or in your family, they are doing the option selling trading, just explain this strategy, because they need this strategy. Without this strategy, so many people are making losses, right? So we have to fix this one. We have to give a hand to some other people to help them, right? So whatever the knowledge you have gained from this one, you have to give it to others. You have to teach others. So let them also get in profit. Okay. Okay. We have some questions. So we'll just explain one by one. Okay. Mr. Monas asked about stop loss. And we have another question. If fix is running high. Okay. VIX you're asking. Okay. VIX is running high. Okay. Stop losses. Again, VIX. Okay. See here. VIX cannot shoot up immediately. Okay. It will be fixed within some half an hour, right? The VIX will get settled. Where there will be VIX will be high only on the RBI newses. Okay. In your table, you have to keep 2 papers. First paper should list holidays. What are the holidays in the next 1 year? You should have the paper. If you are a trader, you should have this paper. Second paper, you should have the economic calendars, RBI newses, election newses, election result, everything. You should have one more paper. Just keep it near you or in front of you. You have to just face that paper. It's clear? Because if you're a trader, you should have these 2 paper. First is the holidays and second is the economic calendar. If you don't have this one, how you will trade, right? Because most of the traders, they will forgot the news. They will take buy or sell. Okay, within half an hour, there will be some news will be there that will be announced by the RBI governor. Suddenly, against their position, market will move very rapidly. They don't know what to do, right? For that one, they should know what are the economic newses, at what time is coming. If it is coming, just close all the trades. After the economic news over, just get into the trade again. Okay, news are very, very volatile. We can't 100% guess it which side will go, right? Because we have the election. Okay. After the election, market will move very, what you call up and down. So volatility will be there. Okay. There is no need to confuse with the VIX and everything. Everything will be included. Only on the news time, VIX will shoot up. So that's I told you. So just keep that paper. If there is a news, just get out of the trade immediately. After the news over, so just you can get the trade because we have lot of time for trading. If today, if you have anything in the home, right? If you're suppose if your this wife has scolded you, right? Mother has scolded you, just don't trade on the day. If you're emotionally not okay, don't take positions because most of the day, if there is if there is anything happen to them, at the day only their capital will go to zero. I've seen number of traders they doing this mistake. Even me in my old days, right? I have done this one, but nowadays I have strictly clear. If anything in my mind is not okay, I won't take the trades. Understanding this one because if you lose the money, there is no tomorrow because again you have to start it from the basic. Again you have to arrange the capital and start everything fresh, right? So that you have to keep it in the mind. If you're not okay today, if your mind is not clear, if you're not settled, if you're not had breakfast, don't take the trades. Some people what they do, they will skip all the breakfast and they'll just get into the trade by 9:30, 9:40. After they feel hungry, they don't have any time to eat also, right? And they have the trade also, right? And they have all full of sweating in the AC, right? So it happens. So if you're not emotionally or physically not okay, don't take trades. Okay. So now we got into the point. Mr. Arun Kumar has asked it. When we should exit from the triple state, okay? So we have the profit showing until expiry or intraday. Okay, let me come to this point. See here. Say for example, we taken the trade by 9:15. Okay, by 9:15. Okay, after that, what will happen? Market will go up and down, right? Okay, all the webinar attendees, there is a one more webinar is happening at 5 o'clock. So we have the intimation from the Alice Blue. We'll just close this session much faster. We will arrange one more session at the next month. Okay, so they can continue this same webinar. So you'll get it in the how we can get it through this channel. Same through the Telegram or through the Alice Blue. You get one more session through me. That is a Kumareshan, right? My phone number is 98940 Okay, you can note down my numbers 98940 You can do WhatsApp, right? Because most of the time, if I'm in trading, at the time the people will asking me the strategy, I can't explain it. Okay, if I'm offline, at the time I'll just explain all the strategies. I have my channel also. That's a Babaji Robo Trader. Because we covered so many stuff, we don't know. Actually, the time has went very fast. Okay, see here. So I'll just explain you very fast how we can just adjustment. Okay, they call it as adjustment or how we can close the trade. See here, 46,900. Everyone is clear in the chart. 46,900, right? What you have to do if the market is traveling half of the break-even point. Okay, see here, 46,400 is our selling leg. That is the higher leg. If the market is crossing 47,200, exit and redo the trade. Okay, exit and redo the trade. Understanding? If the market is crossed half of your leg, right? 46,900 we are ATM straddle. 46,400 is our higher straddle. If market is crossing 47,200 or 150, that's a half of the price. Exit the exit your leg, at the time, at least you will be in a profit of 5,000 rupees. Understanding? Half of the time, if it is crossing, most of the premium will get decreased very faster. Understanding it? Or if the market is going down, half of it, you have to cover the positions, redo the step. How we can redo the step, everything will just explain you in another beautiful session, because we don't have the time now. We'll just explain you at one more session. Okay, thank you, Mr. Mohan. I hope this webinar was very useful for everyone. Whatever the knowledge you have shared, just you can explain to some other person who are just need for this knowledge. I hope this everyone should be master in trading and make huge profits. Okay. Okay. Thank you for everyone. We can join wonderful webinar on the next month. Okay. So we have very, very limited time, 1 hour day only they allotted. Next time we'll just make it 2 hours. Okay. Thank you all.